Welcome to this FundForum webinar. I'm Sarah Armstrong, Editor-in-Chief of the FundForum Conference. Today I'm joined on the line with Karl Tonna, Chief Investment Officer at F&G Funds, Peter Pavlov, Head of Investment Solutions at Silk Invest, and Jahangir, Managing Director, Middle East at Neuberger Berman, who will be moderating our discussion on the current emerging markets investment landscape. If you have any questions throughout the webinar, you can send them to us using the Ask the Question box that you see on the left-hand side of the page. We'll be holding a live Q&A at the end of this session. We also encourage you to join in the conversation on Twitter. We'll be live tweeting this webinar using the hashtag FFwebinar, so please join in. And now I'll pass over to Jahangir.
Thanks, Sarah. Thank you, Karl and Peter, for joining us for this discussion. I think we probably can kick off by just sharing some thoughts on where our personal views or our firm views are on emerging markets to sort of set the landscape. I think after you could almost argue a 20-year anniversary celebrating or remembering the Asian crisis. I suppose it's very poignant that we should have the dramas happening in Venezuela, which again remind us about some of the risks that exist in the emerging world. Nevertheless, I mean, as a firm at Neuberger, our asset allocation committee is currently overweight both the emerging market equities and the emerging market debt space. Some of that is based on relative valuations to developed markets, but some of that's also based on the fact that the emerging markets are now just such a broad pool that once you get inside it and you break it up and you put things like Venezuela at the bottom of the pile and you look at the rest of the emerging market, there's lots of very, very cool and good things going on. Both on the debt side, the spreads remain quite rewarding. The opportunities on the local currency side are quite exciting given the anticipation of a potentially weakening dollar. And so broadly speaking, we feel there's a positive outlook towards the emerging markets. I'd love to ask Peter and Karl to tell us a bit about what their firm's views are at a high level, and then we'll dig into some specific questions. As Sarah said, please do keep those questions coming in. I think it really would help me if the tough one comes in, because that would make Peter and Karl's life tougher, so you get much more value out of this conversation. So, Peter, I don't know if you want to kick off with sharing your firm's views at a high level on EM.
Sure. Good morning, good afternoon, everyone. So, as a member of a frontier market specialist, what I will be saying will be obviously a bit biased, but still, I have to say it. Taking a step back from what you said, actually we used to have crises, different crises, even before the Asian one. Maybe you remember the Cuba crisis and then Russian crisis that happened before. And obviously in the future there will be other things that will happen. And that's the beauty of emerging markets and frontier markets in general, and that's the beauty in financial markets as such. Because when we talk about emerging, it is a category, but then we have a lot of different stories going in there. So some of country level, some of the countries will be benefiting from elevated commodity prices. Basically the importers, they will be suffering from this. And from an investment point of view, we find this very, very exciting because we can try to navigate in this environment and try to select companies that will be better adapted to the current landscape and that will have the capacity to generate good earnings no matter what the environment is, or conversely that will be benefiting from a devaluation happening somewhere, etc. So high level, we think that there is value in emerging markets, especially when compared to developed markets. And also there is, in some cases, even more value in frontier markets because they are simply overlooked by the investment community. As an example, we can just have a look on FDIs. So this is data available on the IMF website, and then you can compare FDIs to portfolio flows. In many cases, you will find that FDIs they often precede big portfolio inflows in many regions, and this is what led us to think that in some cases investment community is too pessimistic. Examples will be nowadays will be Nigeria, will be Kenya, and then as of today will be Egypt or Pakistan and even Russia to some extent. So high level, we are positive on emerging markets, and we even think that we have pockets of value in frontier markets that can be creating an opportunity for international investors.
Thank you.
Karl,
over to you.
Sure. Hi, good afternoon, everybody. Well, essentially, yes, I agree a lot with what Jahangir and Peter you were saying. So I'd like to touch base very quickly on what Peter mentioned with regards to the value. I mean, we have been over the past 12 to 18 months extremely bullish on where emerging markets have been valued. So if we look at post 2008, the mainstream indices, the S&P 500, the Dow Jones, and the FTSE, and then the Eurostoxx rallied considerably. However, emerging markets did not catch up. So that created back in 2014-15 a sort of vacuum of valuation where basically there were numerous stock markets such as China, such as India, such as the rest of Asia, such as Russia and Brazil to a certain extent, which created opportunities. And as people started pulling out of bond funds and into equity funds, we saw a net inflow of investors piling money into equity funds. And when they did that, the valuation space was really entirely purely on emerging markets. So yes, so I agree. From a macro perspective, I think 2 years back that there was a significant opportunity, and year to date you can look at the mainstream indices which are up 20-25% focused on emerging markets. Where we are now, I think we are due a slight correction because the rally is slightly running out of steam. However, we still believe that emerging markets in general provide a considerable valuation space versus developed markets.
Thank you. One of the headwinds that one would expect to impact potentially the emerging markets, and you could argue that it did 2-3 years ago, is oil exporters being challenged, and particularly poignant for those of us in the Middle East, oil exporters being challenged with the significant drop in revenue, but that also has an effect in a number of African countries, Angola, Nigeria, Ghana. So those are sort of starting to stabilize in a better place. And then on the other hand, there's been huge beneficiaries in the EM world like Pakistan, like India, where their oil import bill dropped. So one would say that oil prices are quite important for the emerging market, or their sensitivity to their current account, and as a result their broader balance sheet is quite great. So do either of you have a view on where are we with oil prices and the materiality of them to the EM?
Okay, Peter Aswering, I will take that one first. High level, our view is that we are seeing a clear reaction from U.S. shale producers in the current in the current environment. So we consider U.S. producers as the marginal player, and as oil is a global market, so basically they're setting the price. What we see is that when oil goes down to 45, they stop drilling, and U.S. production is stabilizing. And when oil goes up to 55, or especially on the far end of the curve, they start hedging their production. So overall, our view is that between now and then the year end, oil prices should remain range bound. On the other side, we have OPEC willing to work together with some non-OPEC producers and trying to set a cap on their production. So we have two conflicting forces pushing in opposite directions, and eventually one of them will win, but we don't believe that we are going to see any resolution in the months to come. It might happen next year or maybe even after that. What we know for sure is that countries that have learned their lessons. We have seen that one in Saudi. We are talking about the biggest IPO ever. They are also restructuring their budget. We have seen that in Nigeria. They have replenished their reserves. And when it comes to emerging markets in general, we have also seen that in Russia. They actually, when oil prices collapsed, they let the currency free float and basically absorb almost the entire hit. And in many of the countries, something we should not forget, in many countries, budget deficits are being run in local currency. So, as an example, in Nigeria, the currency went from 160 to 360 today. So much of the hit is already being accounted for. And high level, we believe that current environment is much better being taken into account from local governments than 2-3 years ago. We are no longer talking about oil at $200 per barrel or even 250. We are now talking, and even budgets are being prepared for a slightly, even not so slightly different oil environment. So
Just to continue on what Peter explained very, very well. I mean, from a technical perspective, we're seeing oil stabilize within the $40 to $60 a barrel over the past 2 years, and that has definitely helped emerging markets and frontier markets. Obviously, net beneficiaries of a downward move in oil prices, such as India, were very strong back in 2013 and 14 because oil went down 50% from $100 a barrel. But we are investors, for example, in Iraq, which, as you can imagine, its economy is very, very much correlated to an upward tick in oil price. So we're very, very comfortable with the current level of oil prices. Obviously, it's very, very difficult to kind of give a 6-month outlook projection on oil prices. However, in general sentiment within FMG is that the current stabilization of oil prices and the lack of, so to speak, intense volatility around those prices has enabled the emerging markets to pick up, at least on the equity side.
One of our smart portfolio managers often, whenever we ask him the question of oil, will say that I can explain to you a $10 movement in oil prices by demand and supply. I can explain to you a further $20 of movement by looking at speculation derivatives. But when it's greater than that, I have to just put it all into the bucket of politics, and that's probably very true. So it makes it quite hard for any or all of us to sit there with a very strong view. But thank you for flagging for us the potential impacts of oil moving. Let's just go very briefly to touch on sort of the two elephants of the emerging markets, being China and India. The China story is, of course, we all know very well. It's done incredibly well. It's been a phenomenal 2 decades for it. It feels a little bit that India continues to remain, for the optimist, an area where it's going to become an engine of global growth. It's not quite there yet. I mean, Indian GDP remains, GDP per capita remains half that of Chinese GDP per capita. Can India become a global growth driver?
I already think that India is a global, a very, very strong economy. And, to answer the question, will India become the next China? I would say that we are very close to India being already the next China. Why? Because if you look at, for example, the demographics of India, we have an extremely concentrated demographic sector of people within the 25 to 45 years of age. And essentially, those are the driving force of the consumer, of the economy, of the global economy as a whole. We think that even though there was a setback in the equity market prices last year, I mean, just look at where India is this year. Sensex is up 25% year to date. So we think that the young population, the President Modi, whose policies and his rolling out of policies has been extremely strong, and has been extremely popular within India itself and also within boundaries. I think one advantage that India has over China is that the stock market itself behaves much more rationally than the Chinese market, especially than the Asian market, and I guess we'll touch base on that a bit later on. But so it's the way you see India is it's an emerging market economy with a developed like stock market. And that puts India in probably the best position amongst all the emerging and frontier market space.
Okay, I have a few things to say from myself. Chinese actually, they did pretty well over the past 10-15 years. And what they are doing now, they are approaching the middle income trap. When we look at the numbers, actually, global investors should find typically more value in economies that have more room to develop, rather than economies that are close to the middle income trap. Even if China is still too far from that place. Other things, we used to have a lot of Chinese investors in Africa, a lot. And nowadays we are seeing a lot of Indians moving. So actually it is going both ways. Not only they are receiving investments from abroad, but they started investing abroad. Actually that one started many years ago, even before Mr. Modi came in. But trade flows are moving in both directions. So we are seeing today China moving to Pakistan as an example, with the Silk Road construction projects, etc., and benefiting local economy. Same thing is happening with some of the Indian companies. They are investing massively abroad. So always, in our opinion, we should look at how a country is developing both ways, from inside out and from outside, the investments into local names and local bonds.
So we talked about the two big elephants of the emerging world, but if we just drop a little bit and link this to a question that we've just had from the audience. So the specific question from the audience is, what are your views on Vietnam? But let me broaden that a bit, just beyond just Vietnam. So Vietnam, bright spot, not. welcome your thoughts, but more broadly in a sort of the second tier, the frontier market, and also, please, if you can comment on, Saudi and Pakistan, because those are ones that we see in the news quite regularly, as well as bright spots. Just if I could, Peter, get you to kick off with telling me a little bit more about your thoughts on some of those other smaller markets, as it were.
So, Vietnam, actually, we think it is a top-down. It is a very exciting story. They have room to grow, and actually, next China will be. It is much more. Vietnam is much more close to China than India to China, because India, they already have a very, very important internal consumer base, and market is very well developed. We have seen Chinese companies investing in Vietnam, but basically they are delocalizing. So this is something that happened 20 years ago here in the developed Europe and in the US. What we show some caution when it comes to valuations. As an example, cement companies in Vietnam trade really, really high multiples, while you will find the same names in Pakistan in particular, where due to political risk, valuations are depressed. Even though we have, I just mentioned it, we have huge infrastructure projects and construction is also doing well. But the equity risk premium, in our opinion, equity risk premium is much more elevated in Pakistan than in Vietnam. This is from a pure top-down point of view. Then Pakistan is easy to access. Vietnam is, we have some typical investor, we have some trouble going in there. And then what I'm talking about is just we should consider in Vietnam the bottom-up stories, different bottom-up stories, rather than the top-down one, because it comes with very, very high multiples. Then other potential place, we find a very, very interesting country in the region that will be Bangladesh, where we can find banks and telecoms that will really offer growth prospects. And of course, we have the big disappointment of the year, which is Pakistan. They basically get promoted back to emerging markets. As a result of this, it's ironic. As a result, the market is down for the year, so they are underperforming a lot. And of course, we have politics coming in, etc. But when we have something like 19% negative in US dollar terms for the year, it is a cause of concern. At the same time, we have seen many opportunities in Africa. Maybe it is one of the first years where we can say that Africa is back on the radar screen. We have seen really good performance in both Kenya and Nigeria, and even some of the smaller markets like Morocco, and to a lesser extent the South African markets, not the South African markets, but Sub-Saharan, or the Sub-Saharan names. So to put it in a nutshell, we have several Chinas in the world. The thing is to identify which one is going to perform well and is going to attract investor interest, and that's pretty difficult exercise. Even index providers, they are not very good in that one. We have seen it happening with Israel a few years ago when they got promoted to emerging markets. We have seen it happening with China. We have seen it happening even with India, because they still have limits to foreign ownership investment in financial institutions. So, there will be many more Chinas that will come on the radar screens. That's our opinion.
Peter, Karl, can I ask you to take a similar approach, but link it to another question that we've had from the audience? If you could build it around a comment around the ASEAN countries, Indonesia, Malaysia, Philippines, where where do you put those in ranking more broadly from an equity perspective, and or if you have any insight into their debt from a debt view as well?
I will be very quick
Sure.
on that one. Sorry, it was for Karl or for me? Sorry for that.
Sorry, for Karl.
I'm sorry.
Sure. Yeah, I mean, essentially for those three countries, Indonesia, Malaysia, and Philippines, similarly to India and to the other ASEAN countries this year, on the equity side, they have performed extremely strongly. If I look at the latest numbers, I would say that Malaysia is up 15-16%, Indonesia is up 12-13%. General market. So in terms of looking at it from a macro perspective, I would say that Indonesia is the strongest economy out there. It's growing very, very well. Obviously, Philippines is to a certain extent quasi developed. So again, on the equity side, I think most of the opportunity would be in Indonesia and Malaysia. On the debt side, if I look at the sovereign space, Indonesia is extremely tight, so we kind of would have moved away from that. And same story with the Philippines. I would say that the debt. I would say that the equity market story at the moment for those three countries is better. There's significant more upside than on the debt side. However, as an overall, we are kind of turning away from the Asian countries and focusing much more on India and on the China Asia story, which was a laggard following this significant market correction that happened 2 years back, but has now picked up considerably.
Thank you. Just moving on, because we're actually going to run out of time, and we've still got so much more to talk about. But we've seen Fed rhetoric around around rate normalization pick up. The last time the Fed spent more time talking about it, it created a taper tantrum and an impact on broader EM assets. What do we anticipate is going to happen as we move towards a rate normalization, certainly from the Federal Reserve in the third quarter, late third quarter, fourth quarter, but potentially early next year, ECB? How do you see this playing out and impacting the EM markets?
I think the concern is understandable, and I know even some of our investors are concerned with the rising rate scenario both in the US, which has already kicked in, and also in Europe. However, allow me to make a comparison versus 2013, when the Fed had signaled that the end of the QE policy was forthcoming. At that time, I would say that the communication from the Fed was not up to snuff, and essentially the resulting taper tantrum sent shockwaves through emerging countries' financial markets as well as economies. We do know that since 2008, most of the EM countries have basically borrowed trillions of dollars in the last few years. So yes, an increasing interest rate scenario can be a concern. However, we downplay the risk of an outright crisis and distress, and we think that is much more limited than is being played out in the media. Why? Because the Fed is essentially raising rates much more gradually, much more slowly than in previous cycles. It is responding correctly to signals and signs regarding the economic growth of the US itself. And they have learned from their mistakes in 2013, and the communication to stakeholders has been much more clear and essentially much better. So I would say that the markets are at each and every meeting, at each and every signal, being able to price in, the yield curve and then as a second derivative, obviously emerging markets would follow suit. Another reason not to panic is compared to 2013, policy rates were low in many of the fragile emerging economies, and but basically now policy rates are at or close to double-digit levels, and the authorities are not behind the curve. So essentially, loose fiscal and credit policies have been tightened. So the large current account and fiscal deficits have been reduced. Above all, I would say that since 2013 and especially since 2008, most of the emerging markets, obviously there are some exceptions such as Venezuela, such as to a certain extent Argentina, but most emerging markets are financially more sound than they were a decade ago, and so are much more resilient to any financial fragilities coming from the currency markets, coming from the commodity markets, or indeed a second sovereign debt crisis.
Thanks. Peter, any comments
just
from you?
add, just two, 3 points. What is different this time is that we all know the numbers. Today we are kind of we're in a kind of a synchronized growth environment. We see growth everywhere in the world, even in Japan, and that is a new element that should be taken into account. So even if we see tighter financial conditions in US, in Europe, and in some of the emerging market economies, it is for the good reasons, and that's a sign that the economy is doing better. And by the way, this is what we are seeing. And even when we look at forward indicators, we still feel quite comfortable that macro globally in the world is doing well. The other point is that back in 2013, we had a lot of inflows. Some of this was speculators coming in, etc., etc. Then the tide reversed, and we had emerging market equities and bonds have been hit by a huge wall of redemptions in passive products, in active products, and that money, the money that left it, is still not back in. Inflows restarted again last year. It was February, March last year, but we are way below levels that we were used to see back in 2013. So, from my opinion, my humble opinion is that the absence or the relative absence of portfolio with speculative inflows into those economies, they are underowned. This is what I'm saying. We'll be acting in a positive way. We'll be helping us to limit any potential impact from tighter financial conditions.
Thank you. So just before we wrap up, one final question. And Peter, I'd ask you to comment. One of the things that we hear for the emerging market MSCI index is an upgrade of China, is an upgrade of Saudi. Probability of those events and your view on, are they an opportunity or overexcitement in those two events?
So actually, China is an opportunity for international investors because we are talking about the second biggest market in the world in terms of market cap and also in terms of number of shares being traded. What we don't have, actually here internally, we don't have a Chinese speaker. So if you want to go and buy a small cap in China, you could eventually struggle to finding something translated to English. So that's a market for specialists. But overall, broad picture is that the authorities are moving in the right direction, and that's only a very limited number of shares that is being included in the MSCI EM index, because basically those are the ones that don't have any H share and that are eligible through the stock connects, both Shanghai and Shenzhen. But it is providing a blueprint for other big emerging frontier markets to be included into the indices. What I'm talking about is Saudi. As an example, Saudi today is, I just checked before joining in, it is $457 billion market cap. It is not easily accessible by the international community, and the system they have is something similar to China. Don't have the connects, but otherwise we have the quotas, etc., etc. And what they are doing reforms, necessary market reforms that are going into the right direction. They simplified the quota authorization process. They introduced the delivery versus payment. They started removing some of the hurdles we had with foreign ownership in the traded stocks, etc. And that's positive for the market because market cap to GDP is still very, very low. And just to situate as a reference point, Russian market cap today is 550 billion. So Saudi is 450, and we don't have Aramco being listed. So potential for Saudi to become bigger than Russia eventually, if it is included in the index. And then, of course, you have other stories. The one I mentioned before that, which is Pakistan. It was a very important player in the frontier market index, and now it joined the emerging market index, and basically the investment community lost interest. Something similar happened a few years ago to Israel when it joined the developed market, and we have seen exactly the opposite happening to Greece when it was demoted from developed market to emerging market. Basically, it gained more traction and more interest, and the analyst community started covering that market, and even if they were in financial distress, some of the investors, they found interesting opportunities there. So overall, it is very, very exciting to have a new market in the MSCI EM index. We are on an exponential learning curve, and we will start to understand how the Chinese local market works. They have a lot of very interesting stories inside, and another very important point is that 1.5 years ago, H shares used to trade at a discount to A shares. Now the discount is gone, and given year-to-date performance, H share trade at a premium to A. So yes, having the A share market included into EM index is creating opportunities.
Thank you, Peter. Karl, do you have anything to add to that?
Not much. I think Peter explained the situation in the Asian market very well. I think the only thing I'd like to add are a couple of data points. Essentially, within our dedicated China Asia fund, we back in 2015 we were sitting, following the significant rally of around 120% in the space of 12 months. We took some profit, and we were sitting on at one point 30% in cash. But we slowly deployed that, and we are now fully invested. And the reason behind that is obviously there was a significant correction, so there was a valuation point there which we wanted to take advantage of. But more importantly, I would say that gone are the days that that you would wake up, in the market in the morning, and you would see the Asia market down 10-12%. So what has happened is that the regulator in the stock market has managed to curb down significantly on the retail lending, which was the issue last time around, both in August 2015 as well as in January 2016, where there were significant market corrections. And tying that to the MSCI EM inclusion, we have been advocating that, and we have been telling our investors about it for the past 5 years. We have had to wait, I would say, a bit slightly longer than we expected, but now we're glad to see that it's finally happening. One of the big investment banks has put an inflow price tag on that, and they have estimated that we would see more or less 1 trillion to 1.5 trillion of inflows in the medium to long term, which would make up 15 to 20% of the current MSCI EM index. So once this actually happens, we see the China A-share markets going on a significant upward trajectory, and we, as compared to Pakistan, which as Peter said, is down for the year. I mean, if you look at how the market has reacted, it has reacted positively to this news, and so we're finally seeing what we have long been expecting and long been advocating for.
Just comes to me to say, Karl, Peter, thank you very much for your time this afternoon. Thank you to the audience for taking your time to join us. We hope we addressed your questions. I think Karl and Peter, given the constraint of time, have done a thorough job at giving us a feel of all the different opportunities that exist around the emerging markets. Sarah, back to you.
Well, thank you very much, Jahangir, Karl and Peter. That was great, very interesting. We have run out of time now, but I'm glad to let you know that that you can hear more on the emerging markets landscape at the upcoming FundForum Middle East and Africa conference taking place in October in Dubai. We'll be emailing everyone who registered for this webinar with more information about the event, as well as with a recording of today's discussion so that you can revisit it. Thank you, everyone, for coming along, and thank you to Jahangir, Karl and Peter for leading the discussion. There'll be a short feedback survey popping up on your screen shortly. We would appreciate it if you could take 60 seconds to let us know what you thought about today's webinar and whether you have any future webinar topics that you'd like us to cover. Thank you and goodbye.
Goodbye.
Goodbye.